What gives something value? Is it the belief that others will desire it tomorrow? Or something deeper? Something anchored in the reality of what it can produce today? Benjamin Graham spent a lifetime answering that question. And if he were alive today, watching the rise and fall of cryptocurrencies, he would likely approach them not with hostility, but with skepticism born of principle. He would ask, "By what measure do you call this valuable?" Because to Graham, value was never a matter of popularity. It was a matter of proof. And that single distinction between what is popular and what is provable is what separates investment from speculation, wisdom from excitement. In this video, we'll explore why Graham would likely question crypto's claims to intrinsic value, not out of ignorance of technology, but because of his understanding of reality. We'll uncover how his timeless definition of intrinsic value exposes the fragile foundations beneath speculative assets, and why his framework remains one of the few tools capable of cutting through the noise of our modern financial world. By the end, you'll see what Graham really taught us: that no matter how advanced the markets become, or how digital our money grows, the laws of value do not change. Only our willingness to forget them does. To understand how Graham would view crypto, we must first return to the world he lived in, a world that had already seen its own version of financial euphoria. The year was 1929. Markets soared, speculation was a national pastime, and new financial instruments were said to have rewritten the rules of wealth. The radio and automobile were the disruptive technologies of their day, and Wall Street promised that a new economic era had arrived, one where prosperity was permanent and risk obsolete. Then came the crash. Fortunes vanished, confidence collapsed, and the language of certainty gave way to silence. In the ruins of that illusion, a young Benjamin Graham set out to rebuild the foundations of investing, not on belief, but on evidence. He realized that what destroyed investors wasn't just greed, it was a deeper flaw: the willingness to confuse popularity with permanence, and rising prices with rising value. And so he began a lifelong pursuit to define what value truly means and how an investor might measure it when the world around him loses its reason. Nearly a century later, we've lived through another kind of mania, a digital gold rush where code was crowned as currency and conviction was mistaken for value. Crypto, for many, represented liberation, freedom from central banks, from inflation, from traditional finance. And yet, the rhythm of human behavior hasn't changed. The language of the new era echoes the same optimism of 1929. This time is different. This technology changes everything. But Benjamin Graham would have smiled gently at those words, not dismissively, but knowingly, because he had heard them before. And he knew that no matter how new the product or how powerful the technology, speculation always dresses itself in the language of revolution. To understand why Graham would be skeptical of crypto's intrinsic claims, we must first understand what he meant by intrinsic value. For Graham, intrinsic value wasn't a number printed in a report. It was an anchor of reason in a sea of emotion. It was what a business was truly worth, based not on opinion or excitement, but on evidence, assets, earnings, and a margin of safety. He defined it simply: intrinsic value is that value which is justified by the facts, by the company's assets, earnings, dividends, and definite prospects. In other words, intrinsic value must rest upon something measurable. It is not what people believe an asset is worth, it's what can be demonstrated through analysis and verified through reality. Now, Graham never denied that markets could price things far above or below that intrinsic worth. In fact, he built his entire philosophy on the understanding that markets are emotional. They oscillate between optimism and despair. But he also insisted that value must exist independent of price. A stock's quote on a screen could change by the minute, but its intrinsic worth changed only when its underlying facts did. This is where his skepticism toward crypto would begin, because intrinsic value in Graham's world is grounded in productive capacity, in something that generates or protects future cash flows. A factory, a bond coupon, an ownership claim on earnings, these are measurable sources of value. But a digital token? What cash flow does it produce? What claim does it confer? What facts, not beliefs, can justify its valuation? To Graham, these would not be philosophical questions, they would be analytical ones. And until they could be answered with evidence rather than enthusiasm, crypto, however innovative, would remain, in his view, a speculative vehicle, not an investment. He would not mock it, he would simply classify it. And in Graham's framework, classification was everything. The line between speculation and investment was the line between emotion and reason. If Benjamin Graham were alive today, he wouldn't dismiss crypto outright, he would dissect it. He would not ask, is it revolutionary? He would ask, can it be valued? His method was always the same. First, identify what an asset is, not what the market says it is. Then examine whether its worth can be supported by facts rather than forecasts. Graham believed that every sound investment rests on three pillars: a real underlying business or asset that generates earnings or cash flow, a rational method of valuation rooted in those earnings or assets, and a margin of safety, a discount between price and value that protects against error and emotion. Now imagine Graham sitting before a whiteboard labeled Bitcoin, Ethereum, or Solana. He would begin by asking, where are the earnings? Where is the yield? Where is the claim on future productivity? And upon finding none, he would likely conclude that crypto lacks what he once called the evidential anchors of value. He would note that the price of a digital token is determined almost entirely by what someone else is willing to pay for it, a pure expression of sentiment, not substance. And while sentiment can drive immense wealth for a time, it offers no margin of safety. For Graham, this margin was not just a financial buffer, it was an expression of humility. It acknowledged that investors make mistakes, that markets can err, and that certainty is an illusion. But how can one build a margin of safety around something that has no measurable intrinsic worth? He might compare it to a painting, valuable to those who appreciate it, but not analyzable through earnings or assets. Art, like crypto, may be scarce, may inspire passion, may even change culture, but it cannot be valued in the sense Graham demanded. It can only be priced. And that distinction between value and price was the cornerstone of his philosophy. As he famously warned, price is what you pay, value is what you get. To Graham, the intelligent investor seeks value. The speculator seeks price. Crypto, in his eyes, would live on the speculative side of that line, not as heresy, but as honesty. In today's markets, speculation has found its most captivating stage in crypto. A marketplace open 24 hours a day, global, volatile, and fueled by narratives rather than numbers. It promises liberation, freedom from the old financial system, but in many ways, it has recreated the same psychological traps that Graham spent his life warning against. He often said that the investor's greatest enemy is likely to be himself. And nowhere is that more evident than in crypto markets. When prices rise, conviction is mistaken for insight. When prices fall, faith is mistaken for patience. And through it all, the crowd confuses volatility with opportunity, believing that movement itself must mean progress.
Graham would see in this the same emotional rhythm that played out in every speculative cycle he studied. The instruments may have changed, from railroads to dot-coms to digital coins, but the human impulses beneath them have not. He would note how crypto's volatility doesn't just test financial judgment, it tests temperament. He taught that an intelligent investor must be emotionally prepared for markets to behave irrationally, but he must never join them in their irrationality. And yet, the crypto ecosystem often rewards precisely the opposite: immediacy, excitement, and constant engagement. It encourages the investor to become the speculator, to chase price rather than study value. Social media amplifies this further. Every fluctuation becomes a headline, every prediction a performance. In this, Graham's voice would cut through the noise with quiet clarity. He would remind us that markets do not reward excitement, they reward endurance. That true investing is not an act of faith in price, but an act of reason in the face of emotion. He might even observe that crypto, far from being a rebellion against Wall Street, has become a mirror of its most speculative habits: short-termism, overconfidence, and the illusion of control. And yet he would not condemn it entirely, because for all his skepticism, Graham was not a cynic. He believed that every innovation deserves examination, not dismissal. His question would never be, "Is it new?" It would be, "Can it be valued?" If one day crypto were to produce stable cash flows, tangible utility, or measurable economic output, Graham's framework could evolve to include it. But until then, he would urge restraint, not because he rejected innovation, but because he understood human nature. At its heart, Graham's skepticism was never about technology, it was about temperament. He understood that the markets are not driven by numbers alone, but by the timeless forces of human emotion: greed, fear, hope, and pride. And while the tools of speculation evolve, from ticker tapes to trading apps, the psychology behind them does not. Graham often wrote that investing is most intelligent when it is most businesslike. By that, he meant that rationality must prevail over excitement and discipline over desire. But in every generation, investors rediscover how difficult that is. We crave stories more than statistics. We follow momentum more than meaning. We want to believe that this time, the old rules no longer apply. Crypto embodies this yearning. It appeals not only to financial ambition, but to philosophical rebellion. The promise of a new system, unbound by traditional structures. It tells us that trust can be replaced by code, that scarcity can be created digitally, and that value can exist without fundamentals. But Graham would quietly ask, what makes something valuable if it produces nothing, owes nothing, and guarantees nothing? He would not dismiss the dream behind it. He would simply separate the dream from the discipline. Because for him, the intelligent investor was not defined by what he believed in, but by how he thought. In his eyes, markets are not moral or immoral, they're mirrors. They reflect our nature back to us: our impatience, our overconfidence, our need for belonging. And each speculative era, from tulips to tech to tokens, reveals the same truth. The investor's struggle is not against the market, but against himself.
That is why Graham's teachings feel almost spiritual in tone. They remind us that rational investing is not about outsmarting others. It's about outlasting our impulses. impulses. It is not about discovering the next revolution, but about mastering the timeless virtues of patience,
discipline, and humility. He would see crypto not as a failure of finance, but as another test of human nature, another chance to choose reason over excitement, evidence over enthusiasm. And that, perhaps, is the deeper lesson. Because every generation invents its own illusions of value. Only a few learn to see through them. Benjamin Graham would not have condemned crypto. He would have classified it, not as an investment, but as speculation. And to him, that distinction was never meant as an insult. It was a safeguard. Because when an investor forgets what he owns, or why he owns it, risk ceases to be calculable. Graham believed that every rational investor must first answer one question. Am I investing, or am I speculating? If you are investing, you demand evidence, earnings, assets, and a margin of safety. If you are speculating, you accept uncertainty, knowing that your outcome depends on crowd behavior, not intrinsic worth. Both have their place, but only when recognized for what they are. His wisdom was not meant to stifle curiosity or innovation, but to preserve clarity in the face of excitement. Crypto, like every new frontier of finance, invites enthusiasm. But enthusiasm without analysis becomes self-deception. And so, Graham would have urged today's investor to remain both open-minded and grounded, to study innovation, but to measure it with reason, to remember that price is only a signal, not a truth, that volatility is not opportunity unless value can be measured beneath it, and that the discipline of patience remains the most underappreciated form of intelligence. In the end, Graham's skepticism toward crypto was not about the technology. It was about timeless truth. That value in any form must rest on something more durable than belief. That an investor's greatest protection is not foresight, but humility. And that the real revolution in investing will never come from code or algorithms. It will come from the enduring ability to think independently. As he might have said, the intelligent investor is not a prophet. He is a realist who insists on evidence where others are content with hope. Nearly a century later, that realism remains the rarest form of wisdom. Because markets will change, assets will evolve, but the discipline of thought, the refusal to mistake excitement for understanding, is timeless. And so, as you navigate today's markets, whether in crypto, stocks, or anything that promises the future, remember Graham's quiet counsel. Do not chase certainty. Seek clarity. Do not predict value. Determine it. And above all, invest not with emotion, but with reason. Subscribe and join us in keeping Benjamin Graham's wisdom alive, one lesson at a time, for a world that still needs rational investing.